Okay. Assalamualaikum warahmatullahi taala wabarakatuh.
Salam, sir.
Waalaikumsalam, sir.
Okay. So I hope you can hear my voice. So inshallah today we'll continue again our discussion with the last topic, which is on employees benefit. Okay. So my apology for cancelling the class on Monday. So inshallah today we will basically be referring to employees benefit. Okay. So our main reference will be MFRS 119 on employees benefit together with chapter 4 from your FAR 3 textbook. Okay. From your FAR 3 textbooks. But of course, I just would like to highlight that our focus when we discuss employees benefit is basically to look into post-employment benefit. Okay, post-employment benefit. Post-employment benefit could be one category of long-term benefits which is given to the employees of an entity. Okay. Of course, I will go through again, okay, the categories of employees benefit. But I think some of those benefit you might have basically learned, okay, or has been taught in the earlier courses in financial accounting and reporting. Okay. So without any further ado or delay, so I will just refer to the slide which is provided by the textbook, and I will follow that in terms of the discussion. Later on, I might bring some of the example from my side lah. I might have some other example from other references. I will basically bring it later. For the moment, maybe in the first two classes, I will just follow the slide together with the example provided in the textbook in chapter 4. Okay. So let's just refer to the slide. Okay, I think this morning I have uploaded two documents. One is the slide, another one is just a scanned copy of the examples which I thought relevant to basically discuss with you in the class. Okay. I hope now it will be working. Okay. Can you see the slide?
Yes, sir.
Okay. Okay. So I will be referring to the slide. Okay. So I will just follow the slide together with the examples in the textbook. Later on, might be in the third class, I might bring some other example or question. If I think we'll be having more times, and then we'll be having more discussion on the other examples. Okay. So employees benefit, actually employees benefit is covered by two standards, MFRS 119, okay, and also MFRS, if I'm not mistaken, 126, okay. 126 is basically just a reporting by the entity who manage the fund, okay. So I think we will just focusing more on MFRS 119. So the entity who providing employees benefit to their employees, how would they report, okay, that activities in their financial statement. So that is another standard, which is a reporting by the entity who are managing the fund of the company, okay, the third party who are managing the fund of the entity. But our focus will be on 119. okay, about the reporting. Although the topic here is by the retirement plan, it's actually 119 is more on the reporting by the business entity. 126, if I'm not mistaken, you can check. It's basically the reporting by the retirement plan. Okay, because I think there might be some confusion there. But when you look into the most of the content, okay, it's basically referring to MFRS 119. Okay. So if you look into MFRS 119, okay. So if you look into that box, okay, there are four main categories. Okay, there are four main categories of employees benefit which is given to the employees. Okay, so now let us define. Okay, so if I want to reduce that four categories, I would say that there is only three. Okay, there's only three. Short-term employees benefit. Okay, then you have post-employment benefit. Okay, sorry, if I want to categorize into three, I would say short-term employees benefit. Then you have the long-term employees benefit. Okay, then you will have termination benefit. Okay, let me make it a bit bigger. 2 weeks. Okay, sorry. Okay, so if I want to reduce it further, actually I can say it is only three. Short-term employees benefit, okay, long-term employees benefit, and then you have termination benefit. Okay. However, of course, from this long-term employees benefit, I can basically subdivide it further. Okay, subdivided it further because some of those long-term employees benefit is basically the post-employment benefit. Okay, post-employment benefit. Okay, so when you look into post-employment benefit which is given to the employees after their retirement. Okay, after their retirement, because long-term employees benefit can be given to employees while they are in service, and some of the long-term benefit given to employees after their retirement. This is what we call post-employment benefit. Okay, so the long-term employees benefit can be further subdivided. Okay, one is the long-term benefit, which is given while the employees is in service. The other one is basically benefit which is given to employees after their retirement. So that's why it become four. Okay, it become four. So again, I just would like to highlight our focus is actually on post-employment benefit. That is where the detailed discussion is basically provided in chapter 4 of your textbook. Okay. So the first category, of course, short-term employees benefit. Okay, short-term employees benefit. I think this one, I don't need to actually discuss it again, because by now I would expect all of you should have understood this concept of short-term employees benefit. Okay. So short-term employees benefit is usually a benefit given to employees. And of course, in accounting, we always define short-term by 12 months. That is a common benchmark, okay, which we are using to define short-term. So that means this is employees benefit, which is payable to the employees within 12 months. That means this benefit must be paid to the employees within 12 months. Because if it is more than 12 months, in accounting, we always define more than 12 months. That could be classified or categorized as long-term. Okay. So of course, example is like wages, your monthly wages, okay, or your monthly salaries, some social security contribution, okay? Sometimes you have paid annual leave. This is also a benefit to the employees. Paid annual leave, which means that you can take annual leave, but you are still paid for. You are still paid for. It is not you're taking annual leave the day we should take the annual leave. It is not paid. No. Okay. So you take a leave, but okay, that day is still basically included in the calculation of your salary. Okay, or paid sick leave. Okay. So sometimes company might also share some of their profit with their employees. So if all this is basically payable within 12 months, and then it could be classified as short-term employees benefit. And of course, you can also look into the benefit in terms of both monetary and non-monetary benefit. Okay, non-monetary benefit, you might not be getting the money. Okay, but the company will pay it for you, like the medical care, okay, the housing, okay. For example, like a government servant, you have housing allowance and so on, okay. So you will not get the cash, okay, but your employer are basically paid it for you, so you does not need to pay for it, okay. So that is basically short-term employees benefit. And my expectation is by now, you should have a clear idea about the short-term employees benefit. Okay. Okay. Then, of course, the next category is long-term employees benefit. So if a short-term employees benefit is the one which is payable within 12 months, therefore, the long-term employees benefit is something which is payable, or benefit which is payable, okay, more than 12 months, okay, more than 12 months. I think some of these examples might reflect my position as a lecturer. For example, I can get a sabbatical leave, okay, for example, in IIUM, once you, let's say, just take one example lah. Once you provide a service to a university for 5 years, so that is long term, yeah, 5 years. After 5 years, that's mean after 60 months, a staff, an academic staff can basically apply for a sabbatical leave, okay, can basically apply for a sabbatical leave. If I'm not mistaken, that sabbatical leave is for 9 months. So while you are in sabbatical leave, you are not required to teach. What you are doing is you only do the research. Okay, so you're taking a leave from your from some of your responsibility like teaching, but you still carry out your research. You might not be required to come to the office, and you are still paid for. Okay, and of course you can only get this leave after 5 years, so that's why we say it's the long-term employees benefit. Okay, some other long-term employees benefit is like an example here, like disability benefit. For example, you might be okay, you might involve in the accident. Because of that, you get some disability, and the company will pay some allowance because of that disability over the remaining life. Okay, for example, over the remaining years of service. Okay, you still have with the company, so it's a very long period. Okay. So that is general definition of long-term employees benefit. And as I said before, you can subdivide it further between those who are basically payable while the employee is in service, and the second one is the second one is benefit which will only be paid after the employees retire. Okay. So among the long-term employees benefit, which is given to employees after their retirement, I think the best example which most of you might be able to understand is basically pensions. Okay, pensions. Pensions, okay, let's say the retirement age is 60, so retire at the age of 60. So while you are still alive, okay, that's mean, for example, like a simple example like government. So if you retire at 60, so after your retirement, you will get pension, which is paid monthly until you pass away. Okay, until you pass away. Until you pass away. Sometimes it's also not stop when you pass away. For example, I just take my family example lah. When my mother passed away, her pension is then transferred to my father. Okay, to my father. And then after my father passed away, if there is still their children, which is, if I'm not mistaken, age below 18, it will transfer to them. But if there is no more, then only the pension payment will be stopped. This is what we call post-employment benefit. Pension is long-term. That pension is a long-term because it will be paid over a longer period of time, might be more than 12 months. Okay, might be more than 12 months. Okay, but some post-employment benefit might not be long-term. Okay, might not be long-term, but some of them could be classified as a long-term employees benefit. That is the definition, and of course, the last category is what we call termination benefit. And termination can come from both. It might be come from the employer who basically terminated, or it might come also from the employees who basically want to stop, okay, from working with the organization. And sometime in certain situation, okay, when you are terminated, you will basically be given certain compensation, okay, certain compensation for your because of your termination. Okay, that is also not our focus. So our main focus is actually on B, on the post-employment benefit. Just a recap, okay? Just a bit of a recap on short-term employees benefit. Okay, so when you look into the short-term employees benefit, the accounting treatment is basically to treat it as an expense, okay, as an expense, except if there's expenses can be included into the cost of certain classification of asset, which means that except if those expenses can be capitalized into the cost of the asset. Okay, like MFRS 102 is on inventory, or MFRS 116, because if those expenses can be capitalized, then it will be included in the cost of such asset. If not, then it will be expensed off. Okay, then it will be expensed off. That will be on the debit side. On the credit side is basically recognizing a liability. Okay, recognizing a liability, and this liability will basically be reduced one payment have been made to the employees. So that is a very for short-term employees benefit. It is a very straightforward accounting treatment. Recognize it as an expense and a liability. Okay. This is our main focus. Sorry. So this is our main focus. Post-employment benefit. Post-employment benefit can be categorized into two schemes. Please follow it carefully because you need to be able to differentiate these two schemes. Okay. So the first scheme is what we call defined contribution plan or defined contribution scheme. The second category is defined benefit scheme. Okay, so what are the difference between the two? Okay, so we start with the easiest one, the easier one first. Okay, the easier one is basically defined contribution scheme. Okay, so under this scheme, an entity pays fixed contribution to a fund. If I want to give A good example of this is a contribution to EPF. Okay, contribution to EPF, the employer's portion. Okay, the employer's portion. Okay, so it has been fixed. Okay, fixed mean that of course you don't fix the amount, but you have fixed the percentage. So for every employee, you will calculate based on the same percentage, for example, over their basic salary. Okay, so if the percentage is, let's say it's 10%, that if your basic salary is 1,000, so every month your employer will pay fixed contribution of 100 into EPF. So that is, okay, a defined contribution plan. It's fixed. Once the entity has fulfilled that obligation, the entity would not have any further obligation. Okay, that is the only obligation. So 100 is their only obligation. Enough or not enough, for example, for the employees. Okay, later on when employees retire, they cannot claim further. They cannot claim more. Okay, so once the entity or the employer have basically paid that fixed contribution, okay, there is no further legal obligation. Okay, there's no further legal obligation or constructive obligation on the part of the entity for them to recognize. Okay, so that's why accounting treatment is simple. So I can just sum up, the accounting treatment is the same as the short-term employees benefit. The same. Recognize it as a spend and a liability. Okay. So the liability will reduce and disappear once the payment have been made, and there is no further requirement for the entity to pay. Okay. So accounting is very simple. You don't need to use an actuary's advice. Okay, so how do I explain about actuaries? I think you have heard about actuarial sciences. Okay, so this is, you need the advice of actuaries because they are the expert in making estimation. For example, because this is a for this no need lah, because it's very simple to estimate. Okay, to estimate how much is your fixed contribution is very simple. If it is 10% of the basic salary of 1,000, just multiply 10% multiplied by 1,000. So you get 100. So you don't need to ask actuaries to help you. But to estimate the amount of pension, you need actuaries. Okay? You need actuaries because it will involve a very complicated estimation. Okay? A very complicated estimation. I just give an example. What are the factors which you need to take into? Okay? You need to take into the factors how long the employees will be in your organization. For example, okay? How long will the employees be in your organization for 10 years or 15 years? Because the retirement age is 60. Okay? The employees might join your organization at the age of 30. How do you estimate? Even if you estimate, let's say the employees, okay, will work in your organization until the age of retirement. They join in the age of 30, at the age of 30, retire at the age of 60, that is 30 years. But who knows, whether you will still be alive until 60. So that's why among the factor which you need to take into consideration is basically, what is the English word? Mortality, if I'm not mistaken. Because you never know whether you will still be alive until the age of 60. So that also you need to take into consideration. So in 30 years, for example, how much your salary will increase? Again, it's not something which is easy. Okay? How much your salary will increase? So over the period of 30 years, how do you estimate the changes in the interest rate? So this is the complication. So you need to use advice of actuaries. So of course, that is not discussed here. Okay, that is not discussed here. So of course, we don't teach you actuarial sciences. Okay, so we just give you the figure, and those figure is actually have been provided to accountant by actuaries. So you need actuarial advice to do an estimation. For example, how much would be your pension obligation to your employees. So for defined contribution plan, it is not difficult, but the next one, the second category, defined benefit plan, is basically quite complicated. Okay. So of course, here in defined contribution plan, accounting treatment is simple. There is no requirement for you to do a discounting, okay, because you just treat it like a short-term employees benefits. What is complicated is the next one. Okay, so now the slide give you a comparison. Okay, so if entity pay a fixed contribution into a separate fund, like I say 10% of basic salary into EPF. So the simple calculation which I just give you just now is 100 because it's 10% of 1,000. That is defined contribution plan. But in defined benefit scheme, entity obligation is to pay an agreed amount of a benefit. Okay, agreed amount of a benefit. So when you see the word agreed amount of the benefit, this agreed amount does not mean fixed. Okay, does not mean fixed. So you might agree, for example, when you talk about when I do research with, this is just what I can remember. Okay, straight from my brain, research with State Islamic Religious Council. So among a simple calculation from JPA about the calculation of pension might be, for example, like you have certain percentage which you agreed, okay, certain percentage which you have agreed, multiplied by your last drawn salary. For example, now you don't know how much is your, okay, how much is your last salary in the final year before retirement, but you have agreed, okay. So if you agreed to pay, for example, 10%, okay, of your last year's salary, if your last year's salary is, let's say, 100,000 per annum, okay, and then 10% of 100,000 is 10,000. But if your last year's salary before retirement is 120,000 per annum, 10% of 120,000 will be 12,000. It's not fixed. It can be 10,000, it can be 12,000, it can be any amount, but that amount is agreed by the entity. That means they will have an obligation because they have agreed. So if you calculate it to be 10,000, they need to pay you 10,000, for example. So if the figure is 12,000, then they need to pay you 12,000, for example. That is what we mean by agreed. Okay, agreed does not mean fixed. So this is the difference. So you agree an amount based on certain calculation. So whatever the amount is, the entity will have an obligation to pay to their employees. Okay, so that is the characteristic, the different characteristic. In terms of the risk, since the obligation of the entity is only restricted to that fixed amount and there is no further obligation, the risk is on the employees. Okay, whether the total accumulated fund is enough or sufficient for their life after retirement is up to them. So that's why, for example, give a simple example. That's why KWSP would allow you, if you want to make your own investment to make the money grow, you can do that. Okay, because you need to ensure that whatever money there in EPF, once you retire, is enough, because you cannot claim further. Okay, you cannot claim further from the employer or the entity. So the risk is basically bear by the employees. Both actuarial risk or investment risk is all borne by employees. But of course, on the other side, on the defined benefit scheme, the risk is basically borne by the employer. Okay, because they have agreed whatever it is they must pay, so they must have sufficient fund to basically pay for the employee. So that's why they need to have a good actuarial estimation, okay, a good management of the fund in order to ensure whenever they are required to pay to their employees, they have the fund. Okay, so that is the second differences in terms of risk. Discounting, of course, because you treat it like a short-term employees benefit, there is no reason for you to do discounting. But for defined benefit plan, as I said to you earlier, it might be over 20 years or 30 years. So of course you need to do certain process of discounting. Accounting treatment will be very simple for defined contribution plan. However, of course, for defined benefit scheme or defined benefit plan, accounting treatment is a bit more complex. So from now on, okay, what we basically focus is actually on defined benefit scheme. Okay, a defined contribution scheme, no further discussion, because we already understand the accounting treatment will be very similar to short-term employees benefit. Okay, so now let us move further to discuss about defined benefit scheme. Okay, defined benefit schemes. I also don't know why it started with remeasurement. If you look into the start, actually this should not be, okay, should not be the first issue. Okay, never mind. Okay, it's not in order. Actually, the first issue is this. Okay, so let me just skip. Okay, let me just skip few slides. Okay, actually the first issue is on projected unit credit method. Okay, projected unit credit method. Of course, the term look a bit unfamiliar to. I'm not sure. Might be. My thought is it might be a term which is a bit unfamiliar to all of you. Okay, but if I want to use a term which is more familiar, instead of using the term projected unit credit method, I would just say a discounting process. Okay, discounting process. Because, okay, let me just explain a bit more. When you talk about defined benefit scheme, there are two main items which need to be measured. Okay, first is the company obligation. Okay, the company's obligation, because let's say, take the example, employees join at the age of 30, providing their service years by years until he reached the age of 60, which is his retirement age. Okay, so of course, once these employees provide a service 1 year, 2 year, 3 year, 4 year, until the last years in service, okay, company need to recognize its obligation. Okay, so its obligation will be increasing years by years. Okay, the reason is our accounting system is accrual basis. Okay, it's accrual basis. So for example, once the employees completed his first years of service, okay, his first year of service, the company already required to recognize certain amount of obligation. Okay, you does not need to wait until the payment is made. Okay, so once employee is completed his first year of service, he has already arrived. Okay, he has already completed 1 year service. Therefore, he has a right to certain amount of that benefit. So on the part of the company or the entity or the employer, they need to recognize the obligation. Okay, the obligation. Yes, of course, this obligation will be paid later upon retirement, but you need to recognize it now. So that's why you need to discount, okay, in measuring the amount of the obligation. Okay, so that is what is meant by projected unit credit method. Or I can say that in measuring the obligation of the company, you need to basically basically use a present value method. That is what stated in MFRS 119. Okay, so how would you measure the obligation? You need to measure it according to the present value method. So that is the first main component in the measurement of defined benefit plan, the value of the obligation. I think today I will not explain yet a complex a bit. I'm not say too complex lah. A more detailed examples on how you do the discounting. For today, we will just take some example where the present value of the obligation is basically given. Okay, so inshallah next class, next week, then we will see a bit more of the explanation how the discounting process or the present value calculation could be applied in a much more detailed example. Okay, so for pension obligation, you need to use present value. So remember that. Okay. The second main component is what we call the plan asset. Okay. The second main component is a plan asset. A plan asset is actually contribution by the employer or by the entity towards certain fund. Okay. It can be managed internally. It can also be managed externally. For example, if you contribute to EPF, that means the fund is managed externally because EPF is a third-party organization. So usually you will expect the fund will be managed by a third-party entity or organization. Because the reason is the entity or the employer cannot just don't do anything. For example, they know that years by years they will have an obligation related to, for example, pension for their employees. So they need to ensure, okay, they need to ensure when the time comes for them to pay their employees, they will have enough, sufficient, adequate fund to basically pay their employees. So this contribution is what we call the plan asset. Okay, the plan asset. And of course, this plan asset fund will basically grow. Okay, because for example, when you put your money into EPF, EPF will invest. So when EPF invests, it will got a return, and that return will increase. Okay, the value of your plan asset. So for the plan asset, the principle of measurement is you should use the fair value. Okay, the fair value in measuring the plan asset. But of course, you need to be clear. I think you also have some idea what is meant by fair value, because we already have a specific standard on fair value, which is MFRS 13. Okay, but if you look into MFRS 13, it put an exception. Okay, the fair value of MFRS 13 is different from fair value for plan asset. Okay, so how you calculate fair value of plan asset is basically described, okay, specifically in MFRS 119. Okay, so that's mean it is not using the concept of fair value in MFRS 13. Okay, so this is the two main component. Okay, the two main component, you need to know the concept of obligation, and you need to also know the concept of plan asset. Okay. So based on that, okay, so I will start first here with the two main steps. How would you value the obligation and how would you value the plan asset? Then only the issue of past service cost will come in and the issue of remeasurement will also come in. Okay, so you need to know the basic thing in measuring defined benefit scheme is to be able to measure obligation using using the present value principle and are able to measure the plan asset using the fair value principle as explained in MFRS 119. Okay, so now so stop there for a while. Refer to the examples in your textbook. Okay, refer to the example in your textbooks. Okay, are you okay? Are you still following me?
Yes, sir. Yes, sir.
Sisters, are you still
Yes,
following
sir.
me? Are you having
Yes,
any
sir.
problem? Understand? No problem, eh?
No problem, sir. No problem.
Inshallah. Okay, inshallah. So now to explain that two main concepts, I think I choose example 4.6. Okay, example 4.6. Now this is roughly what are the information which will be given to you in the basic calculation of the obligation and also basic calculation of the plan asset. Okay. Okay. So let's say let's read the information. The present value of the obligation, because we are using present value principle, and the market value or what you call the fair value or the plan asset. So that is the value of both at the beginning of the year, 1st January 2013. Okay. So at 1st January 2013, present value of the obligation is 2,000 and the fair value of the plan asset is 1,600. Okay. Discount rate is very important. Okay, discount rate is basically very important, or the interest rate is basically very important, because whatever obligation which you carry, okay, it will be subjected to interest. Okay, it will subjected to interest because you only will be paying it later upon retirement. So you will carry this obligation over a very long period of time. Okay, so obligation will be subjected to interest. So your plan asset will also need the interest because you are expecting return. Okay, you are expecting return from your investment. Again, your reference. Okay, I'm just using a conventional approach. Like usually, our reference is again the interest in calculating the expected rate of return. Okay, expected rate of return. So it is important for the obligation, because an obligation will always be subjected to interest expense. Okay, when you carry it over a period of years. And for plan asset, it is important because you will use interest as a benchmark or measure to calculate expected return. Okay, expected return. Okay, so that is the first information given. Current service cost. What is meant by current service cost is this is the cost which need to be incurred by the employees over the period of 1 year from 1st of January 2013 until 31st of December 2013. Current year service cost. That means this is the cost to the entity. Okay, since employees complete first years of service, and then the entity need to recognize this as part of their expenses and recognize it as a liability. Okay, because you have not paid. Okay, because you have not paid. So this service cost is arising from the current accounting period. So you have another term, past service cost. Past service cost is a cost which might arise from, okay, from the other from the previous accounting period. So there's a difference. But we start with the current service cost, okay? Because every year when your employees provide service to your company, okay, then it is an expense to the entity, and the entity need to recognize it as a liability, okay, as a liability. But of course, for the employees, it is a benefit, okay? Okay, so don't confuse. Our title of the standard is employees benefit. Okay, it's a benefit to the employees, but it is a cost to the employer. Okay. Of course, we are not expected, usually when you talk about post-employment benefit, you are not expected to pay until the employees retire. Okay. But if due to certain circumstances, some payment might have been made, so what will be the implication? If certain payment has been made, benefit paid mean you paid some amount of money to your employees. Yeah, to your employees. For example, like now you have COVID-19. So in order to help your employees, so although by right you should pay it upon retirement, but you pay some in order to help. For example, so just an example lah. So if there is amount paid, the implication is, of course, it will reduce the obligation. Okay, because you have paid some, and you also reduce your plan asset because when you pay to your employees, you will pay it from that fund which you have contributed. Okay, so of course the next item, contribution paid into the plan asset. So of course company will always make a continuous contribution toward the plan asset in order to ensure that they have adequate fund to pay their employees. And then the last two item is an actuarial estimation. So in defined benefit plan, you always need to seek the advice of actuaries in order to give you the estimation. For example, like estimation of present value of the obligation at the end of the year, okay, and also the market value or the fair value of the plan asset at the end of the year. So now we are dealing for 2 years. So we will be talking about 2013 and 2014. So the first step, as what I have said to you, we need to know a basic calculation of defined benefit obligation. Okay. So any problem with the information, I think should be okay. Let me just go to the first step. Okay. So when you want to calculate defined benefit obligation, you will start with the opening balance, as what have been stated in the question. The opening balance, the present value on 1st of January 2013 is 2,000. Okay. So as I said, obligation which you carry forward will always be subjected to interest. Okay. So interest in 2013 is 10%. So you have opening balance of obligation of 2,000. 10% of 2,000, you need to recognize an interest expense of 200. Okay. So your value of obligation increase. Okay. Because you carry forward this obligation further. So that's why you need to add 200 interest expense to the opening balance of your obligation. Then you need to add your current year service cost, because your current year service cost will add further, okay, the value of the obligation. Okay, so the current year service cost, you can look into both columns together. Okay, so it will reflect that 350 for 2013, 250 for 2014. Okay, then because you have paid some amount, okay, some amount of the benefit to your employees, that will reduce your obligation. That's why the benefit paid is basically in bracket, which means you need to basically deduct it. Okay, so that is the basic calculation. Based on this calculation, based on your calculation, okay, the balance of your obligation should be 2,380 for the year 2013. But if you look back into the question, actuarial estimation is 2,400. Is this not the same? Okay, it is not the same. your book calculation have led you to the closing balance of 2380. However, actuarial estimation of the present value of the obligation at 31st December 2013 is 2,400. Is different. So this is one of the different which will lead to remeasurement. Because according to MFRS 119, you need to use the actuarial estimation. That means when you want to carry it forward to 1st of January 2014, okay, you need to carry it at the actuarial estimate, which is 2,400. That means you need to do some adjustment to your books balance, okay, to your books balance, okay, which means that you need to increase by 20 ringgit, okay, from 2380 to 2,400. That's why when you look into the next column in step 1, the opening balance is 2,400. Okay, because you need to use actuarial estimate. So when you increase the obligation from your book balance of 2380, so that means increase by 20 ringgit to 2,400, this is effects of remeasurement. The difference is what? Can I ask you? The difference of 20 ringgit is what? Is it actuarial gain or is it actuarial loss? Anybody can try? That 20 ringgit, what is it? Actuarial gain or actuarial loss?
Actuarial loss.
Yeah, actuarial loss. Why? Because you need to recognize a higher value of obligation. So the increase of 20 ringgit is actuarial loss. Okay. Initially, your book balance is just 2380. But based on actuarial estimation, you need to recognize a higher liability. So recognizing a higher liability means you are recognizing a loss of 20 ringgit. So I think you already understand. Okay. Okay, you already understand. I think the same. Okay. For 2014, it's basically calculated based on the same procedure. Okay, again now you have the balance for 2014 2642, but actuarial estimate is 2,700. So a difference of 58 again increase. So you have actuarial losses for both years to be recognized. Okay, for both years to be recognized in your OCI. Okay, other comprehensive income. So that is the first step. Okay, that is the first step. The second step, so I think this is all. Okay, this is all further explanation, which I have explained it just now. Okay, just now. Second step, of course, to measure your plan asset. Okay. Second step is, of course, to measure your plan asset. Okay. So your plan asset, the basic principle is to start with the opening balance, which is 1,600. Okay. So here you have interest income because money put into the fund will be invested and you are expected to get a return. So this is your expected return from investment. So using interest as a basis, so 10% of 1,600, that is equivalent to 160. So benefit paid, when you want to pay, you will take from this fund. Okay, so that's why it is also deducted. Contribution paid into the plan is the additional contribution within the year which you have paid into the plan is 150. So your book balance is 1740. Actuarial balance calculation given is 2,100. So there is an increase of 360. Okay, so there is an increase of 360. So you need to recognize based on actuarial calculation. Recognizing a higher plan asset is an asset. Okay, so recognizing a higher value of an asset is actuarial gain. Okay, so I think the concept is the same. So when you remeasure to 2,100, that's why when you bring in into the opening balance for 2014, you bring it at 2,100, then you continue the same procedures. Okay, then you continue the same procedures. So that is the first two step. Okay, the first two step. Okay, so step 3, when you prepare the statement of profit and loss and other comprehensive income. Okay, so this is what you can see. Okay, in your profit and loss, of course you can see current year service cost. What I want to highlight here is, in terms of the interest, you need to present it on the net basis. Okay, because you have interest expense from measuring your defined benefit obligation, and you have interest income from measuring your plan asset. So you need to present it on the net basis. So in this case, okay, for you have many figure over there. The first figure is for 2013. The second figure is basically for 2014. So if you refer back in step 1 and step 2, you have interest expense 200s. Okay, and then your interest income for 2013 is 160. So in the net basis, you will have interest expense of 40. Okay, so 2014, you have interest expense 192. You have interest income 68. 68, is it 68? Because here is, can you check? Let me just check. Sorry, interest income not 68. Interest income is 168. Okay, 168. So that's why the net calculation is net interest expense, because the expense is more than the income of 24. Okay, and in your P&L, you will also see one more item, which is in other comprehensive income is your remeasurement, the changes. Okay, again, the changes between your books balance and the actual estimate, okay, whether it is a gain or losses, need to be presented as a net value. Okay, for example, here you have more gain because from the measurement of plan asset, for example, in 2013, you have a gain of 360. Okay, but from your obligation, you have a loss of 20. So that's why the net basis is net remeasurement gain of 340. The same also for 2014. Okay, so that is basically how you present in your P&L. Then for the balance sheet or statement of financial position, you will also need to present it on the net basis. Compare between the amount of your obligation. You can see the working below the extracts of statement of financial position. Compare between the present value of your obligation, which is 2014 at the end of 2013. Okay, and the market value of your plan asset is 2,100. So the net basis is you have net pension liability because obligation value is higher than the plan asset value. If the plan asset value is higher than the obligation value, then you will have net pension asset. Okay, presented in your statement of financial positions. Okay, up to that point, maybe I can just explain it slowly. Okay, so up to that point, is that clear?
Sir,
Yep.
why in the P&L, the current service cost and net interest expense, we put it as negative?
Why we put it as negative? Or because it is expense. Okay, it is an expenses. It is not an income. I think that is the only reason.
All right, thank you, sir.
So that's why you put in bracket, because both are basically expenses. So if you have the net figure is net interest income, then you should put a positive figure lah. That is the only reason lah, I think, to explain. Because when you have net remeasurement gain, you don't put in bracket. You just want to show that it is on the debit side. If it is a gain or income, it will be on the credit side. That's the only reason, I think so. Is that okay?
Yes, thank you, sir.
Okay. Other question? Yep.
May I ask for you to re-explain about contributions paid into plan assets? I'm a bit unclear.
Contribution paid into plan asset. Like EPF, okay. Example is simple. Like EPF, you will every month you will contribute, correct? Every month the employer will contribute. So you start with the opening balance of your plan asset. So this year, employer will contribute again for every month. Let's say if employer contribute for employer contribute to employees 100 every month. So in total, the annual contribution is 1,200. So this additional current year contribution will add into the value of the plan asset. Is that understood?
Yes, sir. Thank you.
Because you don't only make one single contribution, okay. So that's why you make. That's why I wish the word continuous contribution. So whenever you make more and more contribution, the value of the plan asset is basically increasing. Okay. You need to do that because your obligation is also increased year by year. So that's why you need to make more continuous contribution. So when you make more and more contribution, the value of the plan asset is basically increasing. So that's why you add the current year contribution. What you mean here by that contribution is contribution which has been made in the current year. Is that okay, sister?
Yes, sir. Thank you.
Okay. Any other questions? Any other questions? Okay. Okay. Is it possible for me to continue? Maybe I just continue with one more. Okay, because the next issue is past service cost. Okay, past service cost. Okay, so I have made a simple differentiation between current year service cost and past service cost. Okay, so when I said current year service cost is a service cost to the employee which is arrived within the current accounting period. Okay, so when I say past service cost, so let's say now you are in 2013. Okay, now you are in 2013. I think better we look into example 4.7. Okay, because when you look into example 4.7, sometimes you improve the plan. Sometimes you improve the plan to your employees. Okay, so when you improve and say that it will be affected retrospectively, that means whatever you have paid in the year before that will also be increased. Okay, will also be increased. I think better looks into example 4.7. Okay, this is 4.7. Okay, so for example 4.7 is on page 93 from your chapter 4 of the textbooks. Okay, if you refer to example 4.7, okay, it is stated that enterprise operate a pension plan. How you calculate that pension plan is 5% of final salary for each year of employment. Okay, and employees are eligible to join the pension after 5 years. That means employees will only be entitled, okay, for pension after 5 years. That means if you are still in the first year or second year, that means are not yet eligible. But of course, they will basically calculate, and it become legally eligible by the 5th year, okay, of service. Let's say now in 2016, enterprise improved the pension to 7.5%. Okay, previously it's only 5%. Okay, but now it's increased to 7.5. If it is 5% of 1,000, it's only 5% of 1,000 is only 50. If it is 7.5% from 1,000, it's already now 75. That means the company now is basically recognizing higher costs. Okay, higher costs. Okay, and it will be prospectively backdated to all the years of service the employers have basically work for the company. Okay, starting from 1 January 2013. Okay, 1 January 2013, 14, 15, 16. Okay, so at the date of the improvement, okay, so that means it will be backdated from, okay, from 1st January 2013 until now, okay, until 1st January 2016. So that is 13, 14, 16, 13, 14, 15. So 3 years backdated, okay. So the 2016 is the current year service cost. That one is fine. So because of that, there are certain amount of additional past year service costs which you need to adjust. The company are recognizing, okay, the companies are recognizing more of their obligation, okay, more of their obligation. The example just differentiate between those who are already more than 5 years in service and those who are at 1st of January 2016 is less than 5 years in service. This example is very important before the revision of MFRS 119, because before the revision of MFRS 119, the accounting treatment will be different between vested and non-vested. What's meant by vested and non-vested is, for example, for those employees which have more than 5 years in service, so whenever there is an additional cost, company need to recognize the whole amount immediately because they have already eligible. For the employees which have less than 5 years in service, whatever additional past year service costs need to be allocated to the remaining years in service. An example, if the employees is already 3 years in service, that means they still have 2 years to become eligible to the pension scheme. So whatever additional past year service costs need to be allocated to the next 2 years. So that is before revision. But after revision to MFRS 119, it become easier. So whatever past year service cost, the whole amount will be recognized immediately into the P&L. So there is no differentiation between vested or non-vested. So that's mean here the total amount 470 will immediately be put into your P&L. So if this is the amount, just take the previous example as example lah. Let's say this one. This is extract of your P&L. So you have current service cost. So now with additional recognition of past service cost, you will need to have one more line here called past year service cost 470. Okay, the whole amount will need to be recognized immediately. Okay, immediately into your P&L. No more differentiation between vested and non-vested after the revision of MFRS 119. So I think I will like to stop here, but of course I will allow if there is any further question in the understanding of past year service costs. Any further questions on past year service costs? Are you okay? Brothers, sisters, are you okay?
Sir,
Any question you would like to ask?
sir,
Yeah,
um,
yeah.
why is the journal of the course, the journal that, wait, I want to open the,
The journal,
yeah,
journal
the journal
entry.
of the past service course, why the journal put 570 instead of 470?
Oh, mistake. Sorry.
Oh,
I
okay.
mistake. It should be 470. Okay, 470. Actually, a lot of mistake in this book. I don't realize. I might have realized before, but I've already forgotten. It should be 470. Okay, it should be 470 because it says that the revised MFRS 119 require a total past service cost of 470 to be recognized immediately in the statement of profit or loss, regardless of whether the benefit has been vested or not. 470. I think might be just a typing error. Sorry, sister.
Okay, sir,
Okay.
thank you.
Okay. Any further questions? Okay. If there is no further question, I think it should be enough for today. So inshallah, we will continue from there. Okay, on Monday. Okay. So, sorry, chatbot also. Okay, also nothing. Okay. So I think that is all for today. Thank you very much for your attention. So inshallah, I will continue the discussion on employees benefit on Monday. Thank you very much. End my discussion by Assalamualaikum warahmatullahi taala wabarakatuh.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Dalam.
Thank
Thank you,
you.
sir.
Thank you. Thank you.